Hi everyone, we're Team Digby. My name is Anisha and I'll be going over our research and development analysis.
Hi, I'm Maryssa, and I'll be going over the production analysis.
Hi, my name is Sheldon, and I'll be going over the financial analysis.
Hi, my name's Lexi, and I'll be going over our decision strategy analysis.
And hi, my name is Ashley. I'll be going over our marketing analysis. So let's go ahead and get started. I'm going to pass it over to Sheldon.
Hi, as mentioned, I will be going over the financial analysis for Team Digby. There are four key sections we wanted to highlight that really show the success that Team Digby had through all 8 rounds of the simulation. The first section will be market capitalization, and the second section will be stock price fluctuation. Third section will be earnings per share, and the fourth section will be the relationship between stock price and net income. Next slide, please. So to begin, market capitalization refers to the total value of all of a company's shares. The market capitalization can just be a key indicator to show if a company is stable or if it's having a financial trouble. From an investment standpoint, if you're looking to invest, looking at the market cap is a good way to gauge a company. As you can see from the exhibit, in round one, Team Digby started with a market capitalization of 35 million, and we ended with a market capitalization in round eight of 494 million. Through this time, we were making key economic decisions for our company and for our team that helped increase our market value. Excuse me. Next slide, please. In this slide, I will be discussing the stock price fluctuation. So as you can see in the exhibit, we started with a stock price of $30.83, and we ended in round eight with a stock price of $190.32. As the stock price has a key correlation with the economic decisions that Team Digby was able to make throughout all 8 rounds. In round five, we did have a slight plateau, but we were able to rebound and see continued increased value in our stock price. Next slide, please. In this slide, I will be discussing the earnings per share. And the earnings per share indicates how much a company makes from each share of its stock. So in any situation, the earnings per share for any company, the higher the earnings per share, the better when I'm looking to invest in that company. And so as you can see in the exhibit, Team Digby saw increased earnings per share throughout basically all 8 rounds. We did see a slight dip in rounds 4 and 5, but we were able to rebound, ending with an earnings per share of $22.11 in round 8. But we started with a negative earnings per share in round 1 of negative 23 cents. So this was another key indicator to show that Team Digby made sound financial decisions or sound business decisions throughout all 8 rounds to increase our value. Next slide, please. In this final slide, I'll be discussing the relationship between the stock price and the net income. As you can see, our net income saw increases throughout all 8 rounds, as well as our stock price. This key correlation highlighted the key business decisions that Team Digby was able to make that helped increase both the stock price and the net income. We started with a lower net income in round 1, but we ended in round 8 with 54,000 as our high in the net income. And as mentioned before, we ended in round 8 with the stock price of $190.32. Next slide, please. Now I'll be passing it over to my colleague Anisha, and she'll be discussing the research and development analysis.
Thank you, Sheldon. Okay, so now that we have an understanding of our financial analysis, we're going to go ahead and explore some of the key factors influencing our product development strategy. We're going to go ahead and begin with customer preferences. So in this rapidly changing landscape of technological advancements, our customers also rightfully expect our products not just to keep up, but to also lead the way. Next slide, please. So we're going to kick things off by looking at some of the interesting interplay between performance and size. So over the years, we've observed a compelling trend, as depicted by the graph that you'll see later, mapping customer expectations across segments. So the traditional high-end and low-end segments consistently show a pattern, which means that size expectations normally decrease by 1, while performance expectations increase by 1 each year. So this reflects the ongoing pursuit of our optimized performance and making sleek designs. Next slide, please. So digging a bit deeper, the performance and size customer segments reveal one of our unique focuses. So unlike high-end and low-end and traditional segments, their primary criteria revolve around primary product performance and size. So high-end and low-end customers, on the other hand, consider a broader set of criteria in their decision-making. Next slide, please. So now we're going to go ahead and talk a little bit about the mean time before failure, which is also known as MTBF, which is also going to be known as the lifeline of the product and the product's longevity. So low-end customers who are often driven by budget considerations expect the lowest MTBF, which align with their affordability preferences. So in contrast, like our high-end performance segment demands the highest MTBF, which contributes to also increased material cost. For example, Duck, one of our high-end products with one of the highest material cost due to one of its combination of superior MTBF and performance. I'd also like to mention age, which is another influential factor within customer expectations. The low-end segments lean towards older products, while high-end customers are drawn to the appeal of brand new innovations. So essentially, which means that each time we change the performance and size of each product, its age was also cut in half. So striking a balance between these two was another key factor for our success. And then I'm just going to go ahead and finally shift into gears into the delicate dance of influence by automation, which is TQM and total, which all stands for total quality management, and HR. So automation introduced another layer of R&D completion time, which required a careful consideration before finalizing our decisions. So investing in TQM and HR emerged as one of our strategic moves, which streamlined our R&D processes and ultimately reduced time and costs. So next slide, please. So now I'm going to be handing it off to Maryssa, and she's going to discuss our production analysis.
Hi, my name is Maryssa, and I will be going over our production analysis. The 3 key points I wanted to discuss for us being successful as a team is our production forecast, our capacity, and our automation. Next slide, please. First of all, starting off with our production forecast, we use this as an estimation for calculating future demand in our company. We would use it for finances, materials, labor. This estimation helped us in units establish what we would need to produce for each product line and when. A couple of the formulas that we used to be successful were our contribution margin ratio, which is revenue minus variable costs divided by revenue. The next formula is contribution margin, which is revenue minus variable costs. And the third is production forecast formula, which is sales forecast plus 20% of the sales forecast. We would also run production schedules each round to stay on track and minimize our stockouts or having to take out an emergency loan. However, in round 5, we did overshoot the forecast just a little bit with the traditional and low-end segments and ended up needing an emergency loan in that round. However, this was the one and only time that we did need to use that. In the graph to the right, it displays our average plant utilization, where we wanted to keep our utilization around that 100% average. Over the 8 rounds, we did get a bit better with this and keeping our average closer to that line. Next slide, please. Next, I want to discuss the capacity. Ideally, we did want production and capacity to equal that 100% mark. And over that 8 rounds, as I said before, we did get a bit better with this. By round 8, we did have better production to capacity ratio, with our production being at 15,490 and our capacity being at 13,050. just getting it a bit closer there. And we established that the more units we could produce at once, the more successful we would be in ultimately selling more products. Also, on the other hand, if we did want to get rid of a product, all we would have to do is just diminish the capacity for that product. We could also sell that product off, or sell that capacity off when we didn't need it. If we had too much capacity, we could sell it for 65 cents on the dollar of the original value. So that could become a little financially tricky at times, but we didn't have to do this very often. And if we also wanted to sell off excess capacity, we could use it to invest in further automation, which really did end up helping us be successful in the long run as Team Digby. Next slide, please. So when it came to production with our automation, as said before, we invested in this when we needed quicker production with less human error. We needed to reduce manual labor and be able to work overtime shifts if we needed to. This lowered our labor costs, but we did have to increase our funding, as Anisha said, for our research and development section to buy these new machines. Overall, our automation reduced the labor costs, but it did take quite the investment in the very beginning. And the only downside to our automation was at times we did have to do software updates or reprogram it, just in a few small cases. Next slide, please. And next, I will be passing it off to Ashley to discuss our marketing.
Thank you, Maryssa. Hi, I'm Ashley. I'm going to be talking about the marketing portion of our product. I'm going to focus on 4 main points: the sales forecast, customer satisfaction, promo budgeting, and sales budgeting. Next slide, thank you. First, let's discuss our sales forecast. We use a combination of the basic and the December customer survey score forecasting methods to project our product sales. The basic method involves multiplying the current year's total market size by the future year demand growth rate and the product's potential market share. Simultaneously, the December score forecast incorporates customer satisfaction ratings. Averaging these methods provides a reliable sales forecast for each product. Next slide, please. Moving on to the analysis of our sales forecast versus actual sold line graph, we observe a deliberate strategy here. Our forecast consistently aligns just below actual sales. This intentional underprediction serves as a precautionary measure, allowing for the margins of safety in case of unforeseen setbacks. Oh, sorry. Additionally, a prudent 20% increase in our sales forecast for production mitigates the risk of stockouts. Next slide, please. Shifting focus to customer satisfaction, pricing strategy emerges a critical factor. We competitively priced our products, strategically undercutting the competitors in the price-sensitive and low-end and traditional segments. Pricing adjustments are made thoughtfully, though, with an emphasis on remaining 75 cents to $1.25 lower than the major competitors in traditional segments. Remarkably, the high-end performance and size segments are exempt from the competitive pricing, giving it the lesser influence of the price in customer decisions. Next slide, please. So talking about our promotion budgets, these are the means by which we raise awareness of our products. An increase in customer awareness is closely correlated with a higher investment promotions. Every product has a specific budget for promotions, which highlights the need for tactical modifications. Similar to marketing initiatives, new incentives attracts interest in and participation. Next slide, please. To sum up, our profit margins and sales budget work together harmoniously, with the former serving as the entry point for customers. Improved client accessibility is directly correlated with higher sales investments. Examining industry profit margins closely is a very subtle way to make sure that the company's contribution margin doesn't change. Reaching 100% of the allocated funds for sales and promotions gives one strategic control over G&A and the sales cost, enabling tactical adjustments for the best possible financial position and income statement outlook. Okay, I'm going to pass it over to Lexi, who will be talking about our decision strategy analysis.
Thank you, Ashley. I'll be analyzing our decision strategies, starting with our research and development decisions. Basically, we looked at each product individually and then all of them together as a whole during our decisions. So initially, we decided to keep MTBF on the lower side of expectations for all products to minimize material costs, except for our performance segment product, DOT, whose customers weighed their criteria heavily on high MTBF. So we also prepared for future expectation changes in the traditional and low-end segments by over-adjusting days for the first round and making no change to DEL for the first 3 rounds. This was in efforts to reduce our R&D costs and make room in the budget for investment in a new product in our first round. We decided to develop a new low-end product early on because we predicted this to be our most profitable product segment. We later introduced a second traditional segment product because this segment actually ended up being our most profitable segment. Then after that, in round 5, we realized that even though we met all other expectations for our products, our initial lack in MTBF was making our products less desirable to our customers compared to our competitors. So we then raised our MTBF for each product to meet our customers' levels that they expected, and were able to regain the top customer satisfaction rating for days while adapting to the higher material costs. Now, moving on to our marketing decision strategies. We made our products more appealing to our customers compared to our competition by making sure our prices for our traditional and low-end segment products were lower than our competitors, and our prices were equal to our competitors for the other segments. We also made sure to invest heavily in our sales and promotion budgets early on. We later were able to lower these budgets and maintain our level of accessibility and awareness thanks to our heavy initial investments in total quality management and HR. With this extra freedom in our budgets, we were able to manipulate our income statement easier and allocate more costs to the more profitable products to help smooth out our contribution margin across all of our products, which was also affected by our R&D and production departments. So moving into our production strategy analysis, we had a target contribution ratio for each product of 30%, which was difficult to achieve for all 7 products at the same time, since they all had different price points and expenses. But our strategy did have a bit of a learning curve. So our labor costs and plant utilization were initially over their ideal positions due to our initial lack of understanding of the relationship between capacity and production. But in round 4, we were able to gain a better understanding of capacity, and we began correcting our mistakes in round 5. Thankfully, even when our plant utilization was getting extremely high, our costs were not really affected as much because of our investment in total quality management and HR. We did also try to increase automation by 0.5 for each product each round to help lower labor costs, although there was a maximum threshold for our investment in production per round, so we had to be very careful to choose which products to increase automation and capacity for based on the circumstances and our future plans. So now we're going to be moving into our financing decision strategies. For financing, right off the bat, we decided to increase our accounts receivable time to 31 days to make our company more appealing to our customers. And we decided to decrease our accounts payable timing to 29 days in attempts to lower our labor costs. We also would choose to maximize our long-term debt first and then issue common stock if more cash was needed. And we only received cash from short-term debt as a last resort since it needed to be paid back the following round. We tried to keep cash at an ending balance of at least $3,000 just to make sure we wouldn't have any emergency loans. Unfortunately, we did have one, but it wasn't so big, so it wasn't that big of an issue. We were cautious of lowering our stock price by increasing the outstanding shares, so when possible, we tried to buy back stock first and then repay our long-term debt. And actually, in some cases, towards the end of the simulation, we would actually issue some long-term debt and buy back stock and/or issue dividends all at the same time to manipulate our leverage and working capital ratios to get them exactly where we wanted. So, with all of that put together, finally, we felt that overall, our team's success mostly derived from our abilities to work well together as a team, keep a positive mindset, pay attention to all the little details of every round, and learn from our mistakes. So with that, we were able to be the top performing company of our industry. Thank you.
You.
Thank
Thank you.
you.